Thanks for joining us for a brief discussion on our updated mid-year outlook. At the halfway point of 2019, the U.S. economy is held steady, supported by the fiscal stimulus we've highlighted for 2 years, and corporate profits continue to grow. And at the same time, trade tensions have increasingly weighed on the economic outlook, and we're still navigating a challenging environment. Investing, in general, comes with uncertainty, and market volatility can be alarming, but we continue to encourage investors to look beyond short-term market stresses and consider the real drivers of investment returns, as we believe that mindset is the key to achieving financial success. Fiscal stimulus, via the Tax Cuts and Jobs Act of 2017, provided a boost to economic activity last year through tax relief for consumers. We still believe that fiscal support from the Act will exceed consensus expectations for 2019. Fiscal policy's contribution to real GDP growth should be about 2.2% this year. That's higher than the 1.3% contributed in 2018. Fundamentals have continued to support steady but moderate economic growth in 2019. Financial markets were more skeptical at the end of last year, and recessionary calls were among the loudest they've been all cycle. So far, though, that outlook has failed to materialize. And with the Fed on hold and fiscal stimulus in place, we believe fundamentals are supportive of continued moderate GDP growth this year. However, progress on trade remains central to our growth projections. With negotiations stalling in the second quarter, we've slightly reduced our 2019 GDP forecast to 2.25% to 2.5%. Even if we see growth slow, the U.S. job market continues to be a bright spot. Hiring has continued at an above-average pace for the expansion, and weekly claims for unemployment benefits have dropped to cycle lows several times already this year. Strong job growth leads to higher incomes, stronger business and consumer spending, and improved corporate profitability. Productivity growth, though, is the key to sustaining this virtuous cycle. We saw a glimpse of this in the first quarter as productivity grew to its strongest pace since 2010. Fixed income investors have benefited from falling rates due to subdued consumer inflation, pause in rate hikes, and demand for U.S. Treasuries. Although a flattening of the yield curve has been troubling for some investors, we believe this flattening is due more toward global investors searching for better yields than it is as an indicator of a looming recession. Considering the Fed, inflation, and our expectation for progress on trade, we now look for the 10-year Treasury to reach 2.5 to 2.75 in the next 6 to 12 months or so. From a bond perspective, we currently favor an emphasis on investment-grade bonds and fixed income allocations, with a focus on balance between investment-grade corporates and mortgage-backed securities leading the way. The mid-year market turbulence has been uncomfortable for all of us, and it may not be over. Several market risks are still present, including the geopolitical environment, the possibility of failed trade negotiations, and a potential monetary policy mistake. These risks could fuel projected bouts of volatility, with trade the key to projected growth. The overall U.S. economic picture has supported continued expansion. Modest inflationary pressures help boost demand and support corporate profit margins in the first quarter. Given solid fundamentals, we continue to believe corporate profits will exceed the current consensus expectations. Market valuations remain favorable in the U.S., with the S&P 500 forward PE ratio well within its historical norms. Although we did reduce our S&P 500 earnings per share forecast to $170 for the year end, that's mainly due to trade uncertainty. Our year-end S&P 500 fair value estimate, however, remains at $3,000. And we'll revisit that forecast if clarity on trade and monetary policy result in any improved outlook for corporate profits. Thanks for listening to our update. As always, if you have any questions, please don't hesitate to reach out. Thanks, and have a great day.